Okay, I know people are still gathering, but let's go ahead and begin. Once again, thank you all for joining us. For those of you I have not yet had the opportunity to meet, my name is Lena Dobrier. I'm the Director of Operations at Opus Connect. For those of you who are not too familiar with us, we cater to lower middle market M&A professionals. We're a membership-based organization. We have members across private equity, investment banking, lending, independent sponsors, quite a robust network nationally. We do a number of events, these webinars, lunches for six. Many of you are participating in our manufacturing and industrial focused Deal Connect after this webinar, where we pair up capital providers and investment bankers for one-on-one meetings. So a lot going on at Opus Connect. Stay tuned, we'll be in touch. But if you have any questions in the meantime, feel free to reach out to myself or anyone else on the team. Swayze Yancey, his contact information is below. Any of us will be happy to answer any questions that you have. I do want to make a note about Q&A. So I'll ask that everybody submit their Q&A in the Q&A bubble at the bottom of your screen. During the discussion, if you could please refrain from using the chat function, we won't be monitoring that. If you have questions for the panel, go ahead and submit them in the Q&A and we'll get to as many as possible. I do want to give a moment for each of our sponsors to say a few words. These events would not be possible without them. Sapient Investigations, David Kogan, has been a longtime supporter and friend of Opus Connect. David, go ahead and introduce yourself and your firm, please.
Good morning, Lena. Hi, David Kogan with Sapient Investigations. Yes, we have been a longtime sponsor of Opus and great to be here today. And thanks for having us. Just quickly, we're an international corporate intelligence firm. We really specialize in backgrounding all the individuals and throughout the deal ecosystem, looking basically at management teams. We work with large lenders, looking at borrowers. We look at joint ventures, really everybody in the process. We also have a very robust business dispute practice, so we do a lot of litigation as well. And looking forward to the conversation. Thanks for having us.
Thank you, David. Next up, we have Plant Moran. Plant Moran has sponsored a bunch of these over the last couple of years, a newer partner, but a great partner, and we want to give them a moment to introduce themselves. So Daniel Williams is on the line. Daniel, please introduce yourself and your firm.
Thanks, Lena. Hi, this is Dan Williams with Plant Moran. I'm a principal in our transaction advisory services group. Plant Moran, in the accounting, tax, and consulting world, is probably the 10th or 12th largest in the US. We have over 3,000 staff across 24 offices. You know, our brick and mortar predominantly is in the Midwest US, but we have offices also out in the Denver area, and then internationally in India, Japan, China, and Mexico. An affiliate of our practice is P&M Corporate Finance, which our investment banking group has about 30 professionals and services a number of different industries. So we look forward to kind of connecting with everyone throughout the day.
Thank you, Dan. And last but not least, of course, Alliant Insurance, Fran Yurkovic. You may have met her in Chicago last night if you were a part of any of our Deal Connects or dinners that we did. But Fran, please go ahead and introduce yourself and your firm.
Thanks, Lena. This is Fran Yurkovic with Alliant Insurance Services. I'm a senior vice president in our mergers and acquisitions transaction advisory group. We are a top 5 rep and warranty broker. In addition to traditional rep and warranty insurance, we also specialize in tax and litigation insurance. So we are very active as well in providing diligence services to any investors who are acquiring companies. We have a lot of specialty focus groups as noted in this slide, inclusive of healthcare, construction, education, and I'm glad to be part of or a sponsor of Opus. Thank you.
Thank you, Fran. We are going to ask one poll question before we begin. So I'll ask that you all participate for a moment. I'm going to go ahead and launch it. We just want to know who you are. It'll help our audience, our panelists get a better understanding of who they're speaking to. And we will begin shortly after. We're going to give it about 20 seconds or so, so bear with us and then we'll get to the discussion. Okay, so it looks like 10% independent sponsor, 20% investment bankers, 20% on the capital provider debt side, and 20% on the equity side, 30% service providers. So thank you all for participating in that. And without further ado, I want to introduce today's moderator, Carrie DiLauro of Hamilton Robinson Capital Partners. She has been an active member in Opus Connect for a while. She co-chaired our Women in M&A Opus Mind group. She's moderated a bunch of panels. She's the director of operations of HRCO, as we call it, Hamilton Robinson Capital Partners, with 20 plus years of experience in operations, specifically in manufacturing and industrial. She's been on the ground in facilities across the world. So without further ado, Carrie DiLauro, the floor is yours. We're excited to have you lead today's discussion. Thank you for being here.
Thank you, Lena, and good morning, everyone, and thank you for joining us. Hamilton Robinson is a lower middle market private equity firm. We sit in Stamford, Connecticut, and we focus mainly in industrial B2B services and any kind of highly engineered manufacturing here in the US. So I think we have a really great mix of vantage points on the subject of supply chain for all of you today. And I hope that you'll all get something really actionable out of this discussion. So I think we'll kick it off with you, Wendy, as our supply chain expert. Could you give us an overview of the state of the supply chain in the US? And really, what are the factors that are most affecting the supply chain today? And maybe go beyond what we all see in the news, the ships anchored outside of California, or the problems that Amazon is having trying to make good on their 1 day or even 1 hour deliveries.
You're muted, Wendy.
Rookie mistake, and we're only like 2 years into this. Sorry, guys. Thanks for having me. As Carrie mentioned, I am about 20 plus years of a deep practitioner around supply chain, having formerly been the CEO of Lenco Supply Chain Solutions, which many of you know. I've now ventured out into my own consulting group I'm a founder of and the CEO, and we specialize in value creation with private equity and their portfolio companies in digital transformation, supply chain transformation, operating performance management, and particularly helping connect businesses with private equity funding. So with that in mind, I think it's interesting. I think we all thought that this concept of supply chain being highlighted in the news was kind of a fleeting thing. It was preempted by COVID and the pandemic. But what I think it really did was it created a movement, within the entire world. And it really emphasized just how important supply chains are to every business, whether you're in manufacturing or e-commerce, and worked with all of those types of companies. I think the disruptions are going to continue on a grand scale for all the reasons that you see on the news today. A lot of those are geopolitical in nature. And while we can't control those trade route disruptions, there's a lot of tighter regulatory controls. I think we're gonna continue to see things like the embargoes play out. Obviously the resurgence of the pandemic is affecting cross-border closures, but I think more importantly, where we're seeing the issue there is still just around continuity of labor, and also the irregularity of the policies around the vaccine mandates and what that means to businesses today and everyone that they rely on up and down the supply chain. We've all heard about the consumer demands. You've experienced it, whether you're in industrial manufacturing or you're Amazon. Consumers are expecting to be able to order things today online, which means you have to have a digital presence, even in the industrial markets. And you have to have a supply chain that can actually create, and fulfill orders within a much shorter time frame than what you're used to. And I don't think that's going to go away. I think it's continuing, and it will continue to compress. There's infrastructure instability. You know, it's, and not just within the US, but really on a global scale. Capacity on trucks, you know, trains, airplanes, cargo ships, is still hard to come by. You know, it's available, but at a much higher price than it was before, causing people to rethink their strategies. It takes, you know, much longer to get products from point A to point B. Materials availability from overseas, you know, people have been forced to look at, you know, different sourcing options and even bring those, you know, closer to home. And then, as I mentioned before, labor continues to be an issue there. So there's all these looming threats, like fuel increases is the next thing for us to think about. But I think what it has really highlighted is that volatility in the supply chain is here to stay. And people that have just expected this to be a surge and then it kind of go back to, you know, some level of normality and how you dealt with your supply chain are really behind the 8 ball right now. You know, supply chains have just not been built for resiliency around this type of volatility. And people are having to really think about re-architecting their supply chains to mitigate risk in the future.
Up next, I'm going to throw it over to Steve Zelac as our intermediary expert. So Steve, as you engage with a company or a management team, where would you rate supply chain? A top 5, a top 10 consideration, or maybe just a nice to have a few points in the sim? And has that changed over the past 2 years?
Good. Yeah. Thank Carrie. Just quick intro as it gets started. So I'm Steve Zelac. I'm with Young America Capital. We're a investment bank, registered broker dealer, focused in on the emerging and middle market. I lead within the firm. I lead all of our industrials, chemicals, and manufacturing space. So that's the relevance here. So we focus predominantly on capital raises, but do M&A advisory, both sell side and buy side, just from a perspective. So to answer your question, yes, you got to kind of look at it from both perspectives. Again, both the sell side as well as the buy side. Inclusion of supply chain, it's an important aspect. It's one I think that it should be highlighted. We try to bring that out. It's kind of a I'm going to put it middle of the road. You said, you know, kind of 1 to 10, put it right in the middle, about 5. It's a benefit for companies to be able to promote and show how their efficiencies and how they're controlled. It could be an extreme detriment if your supply chain is not well established. And unfortunately, I'll have to say is when you get into a sell side engagement, if as you're getting started, the company has not spent a significant amount of time or has not focused on it, it's probably a little too late at that point. It can be promoted as a synergy for the buyer, however, without too much emphasis, because then it will continue to highlight the what's missing. From the buy side, again, as representing buyers, definitely a great synergy opportunity and one you should be looking at to see what improvements you can make and how you can assimilate that as you integrate the organization.
And next up, we have Ken Hoefling, who will give us the private equity perspective or the potential buyer perspective. And Ken, to you, how deeply do you dig into supply chain? And where would you rate it? A top 5, top 10, or really something that you work on post-close? And has this changed over the past 2 years?
Well, good morning, everyone. Thank you, Carrie. Glad to be here. 30 years of experience in the industry, being an executive at Caterpillar and now in private equity for 3 years. This is a unique time that being in private equity that I would tell you, I would have to bifurcate that answer, Carrie, pre-COVID and post-COVID. Pre-COVID, most of our deals in lower middle market, we always assume that as a buyer, there's going to be hidden alligators in some of these smaller companies, lower middle market companies. We would, you know, from a complexity, we'd always look at complexity of the supply chain. We take a look at the concentration for critical suppliers and critical parts to understand what kind of risks are associated with the way they have their supply chain established. What about their purchasing power and sophistication? Understanding the capability and just the overall power that they have from their staff, and then the commodity exposure that they have as a business and where they're located. And, you know, for my 30 years experience in a very relatively stable environment for the past 30, that would serve us well. But then once COVID hit, you know, everything changed, right? And now what we would assume prior to COVID was not going to be an issue and maybe we'd put off post-close has now been brought to the forefront as a buyer. For example, freight in and freight out. Used to be something you could count on. You never had to worry about it. Pricing, yes, we knew spot prices would fluctuate, right? But we would never have to worry about a 3PL or one of the big carriers just all of a sudden canceling your contract because maybe they can make more money serving the e-commerce, right? Single source non-strategic parts. Who would ever have thought that non-strategic parts that are single source would be an issue in today's global supply chain? But it tends to be the most significant issues that tend to stop some of these smaller companies because they just assumed it would always be there. That supplier would always be there. And pricing volatility of some non-strategic parts. Again, it's the end of the tails of the supply chain now that are starting to hit both companies. And as a buyer, you got to understand what risk are you signing up for as you look at their complete supply chain in a post-COVID world, because there's nothing given right now that you can count on, in my opinion. So when I rate that pre-COVID, we would handle most of the strategic supply chain issues, and they'd be in the top 10. Post-COVID, that is quickly rated. You know, we got to look at these in the top 5 to understand what are we signing up for and what's hidden, and what do we got to help the management team get their hands around.
And Ken, I know you recently shared with us that you actually had a deal where the process broke down over a supply chain issue. Could you just give us some more details, maybe even lessons learned?
Yeah. So a couple different deals that we've done. One was right at close. We had a freight out supplier cancel one of the long-term contracts that this company has had. Very successful. It was one of those where it was kind of put on autopilot. They would always pick up our freight. They delivered on time. They would have no issues. And then because of the continuing struggle with their labor, and I'm assuming they're trying to optimize their margins, they cut us off on certain dimensions overnight. And so we no longer can take anything over X amount of feet. And that put us in a real bind. We found somebody else. Unfortunately, the contract that was being offered was significantly more expensive and less reliable. And so you can imagine we just bought this company, and all of a sudden what we thought was a very stable, very cost-effective solution, and we depend on freight out as a competitive advantage because we serve the nation out of one site. It really threw our operations upside down, and we had to scramble. And in today's environment, we had to basically insource freight in the short term, and now we're looking at that being a long-term competitive advantage where we're going to manage our own freight out. You know, I can remember in the late 80s and early 90s, we were doing that as just a course of business. And then the last 30 years, those things got outsourced. So it seems that we're looking at things are coming back full circle. The other supply chain issue that was that almost derailed something was one of our processes was the fact that one of these non-strategic parts that you would just assume $2 to $5 parts that would never be an issue. This was a commodity, but it had a special steel associated with it that was readily available, but it wasn't that high volume, high commodity type part. All of a sudden, the steel became very scarce, and we were single source on it. And so again, that threw our supply chain, and it basically shut down shipments for almost 4 weeks. And so we had to scramble and to determine what to do, how to try to get some dual sourcing into the supply chain. And how can we, more importantly, is we've got now a bigger backlog that we had to work out a recovery plan, as well as support the continuing increase in the sales that we have. So it's kind of that double whammy. So when you look at that, we are now looking at it a little bit differently, like I said. And when I first got into private equity, it was a very traditional, look at your top 10, look at your concentration, like I said before. But now we're saying, look at your top 10 single source parts. I don't care how much you spend, how little you spend, one part can kill a whole company for 4 months, 4 days, 4 hours, right? And we need to take a little bit different approach. And that's what we're starting to do now, is dig in a little bit deeper, just like we would do in a customer concentration. we're really focused in on that supplier concentration and the risk associated with these parts.
And Wendy, we'll hop back to you. What do you see as the main levers in supply chain that a management team can really implement to become this more agile, efficient, and really gain that competitive advantage in the marketplace that ultimately should drive a higher valuation at sale?
Yeah, so I think Ken, he hit on the sourcing and making sure that you have, a deep bench of either suppliers or service providers from a logistics perspective. One of the things that we talk to a lot of the private equity groups about is their forecasting models, and we've seen a tremendous shift where companies used to have the luxury of forecasting their sales based on historical activity, and they're typically pre-planning 4 to 8 weeks out. We're working with customers today that are now having to do scenario planning. So instead of forecasting using historical trends, we're actually working with them on scenario planning, identifying their risk points, and then creating plans for each of those. So if this happens in the future, which we think may happen, here are the 3 things that we're going to do to offset that risk, which has a financial impact as well as an operating impact, and then obviously our customers' experience. So I think, this concept of forecasting, and you have to be very intelligent, and you have to do it with surgical precision now. And you also have to do it using variables that are not really known, use past trends, but you just kind of have to think forward using your, magic, ball and trying to identify what could happen and making sure that you have good plans in place for if it does. That's my first point. The second point really comes down to the architecture of your distribution and manufacturing footprint. And this is where we see, some of the biggest impact, which impacts then inventory and logistics. But there's been a cyclical every 2 or 3 years. There's this do we consolidate everything into a bigger warehouse and move everything from there, or do we deconsolidate and put product and sub-assemblies up into regional pockets? And it's expensive to move back and forth between those. But there is a longer term strategy on how you can optimize the footprint of your manufacturing, your sub-assemblers, and then your, and in relation to your customer base and where your finished goods need to be. And so, doing that, optimizing looks at, what are your manufacturing operations? What do they look like? Who are your sub-assembly partners? And let's eliminate as much redundancy as possible. So a lot of times with private equity, as you guys are buying companies and you create a platform and you're adding in, you will end up with, a finishing process that's in 2 different places. And it may make sense to do that initially, on one coast and the other. But right now it may make sense to pull it back into the central part of the US, reduce that redundancy. And what goes along with that is then just making sure that you have the right product in the right place at the right time, and reduce the number of times it has to move. And that's like Lean and Six Sigma 101. But we don't have the luxury of not optimizing that, because every time a part or a finished good moves in your supply chain, it costs a tremendous amount of money today. So just being able to kind of optimize, that concept. And I think, finally, supply chain is like one of the last things that people invest in from a digital perspective. And it's one of those things that I always like to say, get it right first and then automate it, right? So that you can get it right faster, and at a lower cost. And so, there is so much technology out there today that has a low barrier to entry. That it gives you transparency, it allows you to automate, those best practices so that you're not having to throw labor, through manual processes. And it provides that transparency for you and the customer so that you can plan better, see where things are, be a little more proactive. It improves your accuracy, but ultimately it's going to create scale, and it gives you that resiliency and the ability to pivot, as things happen in the market. So from a technology perspective, I'd say jump on the digital bandwagon when it comes to supply chain opportunities.
Steve, give us your perspective on the sell side. As you prepare a company for sale, do you typically highlight supply chain or even dedicate a page in the SIM to supply chain? And is that something that you're now considering, or are really starting to, must, really should be in our SIMs going forward?
Yeah, no, thanks, Carrie. Yeah, so sell side transactions, as I alluded to a little bit before, and my background, I'm doing investment banking now. My background is principally on the corporate side, corporate development, corporate strategy, including supply chain management, Six Sigma, and the like on the corporate side. So I'm going to kind of give you sort of a blended perspective on that as well. So yes, it's an important aspect. It definitely needs to be highlighted. It will be a question that comes up within a management presentation. It's going to be information that's going to be clearly needed for companies as they are looking at an opportunity to make sure, as the things that Ken mentioned, that aren't going to happen. So you're not surprised they have closed, that you show up and all of a sudden the parts that you expected to be there and the processes are not in place and the like. If you have the luxury, as I mentioned, of planning, and you're going to be engaging in a sell side transaction, somewhere from 6 months to a year from now, you should be dedicating some effort to pre-planning and getting that in order, and potentially hiring experts like Wendy to come in and others to help you out with that effort. So for sure, again, if you've got gaps, you're not going to be able to hide behind it. So you may as well get in front of it and identify what you got and what you need to correct. And if it's something, as Wendy said, with information and with better strategic planning and scenario planning and forecasting, you can get around. That's the important thing. And if you have, as Ken alluded to, single sourced parts that are integral to your manufacturing process, assembly, distribution, and the like, by all means, try to stock up on those before you start your process, so that you're in good shape.
And Ken, from your perspective, when you're doing diligence on a company, does a company really have to have all these supply chains issues worked out prior to the sale for it really to make an impact on valuation? Or would a roadmap, if Steve sort of gave you the roadmap in the SIM of potential improvements, would that be just as good?
So that's a really good question, Carrie. And I'm going to go back and reference a process, an exit process that we did late last year. For the first 9 months of 2021, we had this company. We worked with our advisor. We built a great story, a great SIM. The company was growing fast. We were doing really well, even through COVID. We had a demonstrated supply chain that was robust. We really didn't have any COVID adjustments that you would expect during this period. And we were feeling really good about it. Lo and behold, right at the LOI stage, guess what reared its head? Supply chain issues, right? We had the outbreak in the Midwest. Delta was killing our attendance. We had steel that was becoming an issue, and it all kind of coalesced around that October timeframe that we were expecting LOIs to come in. The good thing, to your point, was we could go and reassure everyone, here's our processes, here's how we plan for this. This is only a 2 to 3, 4 week bump in the road, and here is why. We're not perfect. Here's some of the issues we still want to work through as a new owner. Here's the path, the strategy this team is on. And the reason it worked is because they could see that this team knew their weaknesses. They had demonstrated, even through the worst of COVID in early 20, late 20, early 21, that this team knew how to manage it. But there's going to be ups and downs with manufacturing. But the reality was they had a plan, they executed the plan, and the new buyer got confident that it was rock solid. And while not perfect, it was doing better than everyone else. So having that current and future plan and execution is really, really important.
All right, Wendy, the question that everyone wants to know, can you give us some timeframes and some cost savings around some of these supply chain improvements that can be put in place?
Yeah, happy to. I mean, we've worked with over 65 private equity groups and literally hundreds of companies in many different industries, but industrial and manufacturing happen to be the heritage of a lot of the company. I mean, I can tell you that, supply chain is difficult to quantify. And it's really difficult to kind of unpack because there's no line item on a financial statement, an income statement, a balance sheet that says supply chain, and this is what it's costing you, right? It's all buried in almost every line item associated with it. There's labor impacts, there's fixed asset utilization, there's just a myriad of areas that supply chain impacts the financials and the operating performance of the company. So, I think it can be complicated, but if you can just, kind of focus yourself in on those 3 or 4 key impactors, there are tremendous benefits. I mean, just about every company that we've been into, we either go in to solve one problem, which could be an inventory imbalance. They've got too much working capital tied up, in this inventory, and they're asking us to come in and bleed out that inventory, right size it. And free up, some working capital to provide liquidity on an exit strategy, for instance. I think overall, if you look at inventory distribution, logistics, and then your operations, which includes your labor around supply chain management, if you address those 4 areas, you can easily get a 5 to 10% bump on your profit margin. Now it will not show itself on any particular line item, but you're able to see those dramatic improvements in those 4 areas across your financials. More importantly, from the private equity perspective, whether you're looking at buying a company or whether you are looking at exiting a company, addressing the supply chain and having it at least be mature, in its ability and its resiliency can easily boost valuations 2 to 3%. We actually had a company that we worked with most recently that was about $100 million manufacturing company. By addressing those 4 levers, we pulled $16 million in improvement out of that company. And it was actually part of the exit strategy. So this particular company decided that they were going to address the supply chain so that it could impact their valuations. It improved their valuations by 4 times. Now that is a tremendous, a tremendous amount of power when it comes to selling in the market, and a 4 times boost on the valuation. So I think it's easy to get a 2% and a 2 times boost just by applying some best practices and some normal things. If you're willing to dig a little deeper with some surgical precision, it becomes a tremendous lever for your either buy side or sell side.
Steve, back to you. How have you handled all this unpredictable surges or lulls in the problems with supply chains as they, play out in a company's EBITDA or their revenue while crafting your SIM or in the middle of a process?
Yeah, I was going to say, I was going to add to the comment. We've been focused in predominantly on the comments on sell side, but I'll also tell you that this has a major impact on our capital raise portion of our business as well, as we present companies and their future financial forecasts to lenders or other capital providers, mezzanine providers, and the like, who are going to investigate that in a very similar same way that a purchaser of equity will, because they're lending and they want to know what their coverage is and whether they're going to have a problem coming up going forward. So can you repeat the second part of the question just to make sure sorry about that.
How do you handle when you're going to the sale process and even when crafting the SIM, if a company has either a lull or has actually been the beneficiary of some of these surges in supply chains? And is there anything that you've seen that has really helped to try and smooth out the story?
Yeah, so the smoothing out the story, Carrie, really comes to the line item you're going to see in a SIM, which is called adjusted EBITDA. So as you're presenting the book, you certainly are going to take that into account with whether it's extra cost or benefits and the like. You usually are not going to be downplaying it, but when you have a shortfall that's caused, for instance, that we've got an engagement right now, which is they make and assemble parts in China, import them here to the United States, then distribute them to their primary customers. And the EBITDA and gross margins associated with those parts were down significantly in the fourth quarter because with the backlog and the shipping and the like, they had to essentially air freight things that normally would come over in full container loads. And again, you need to be able to understand, highlight that, explain it to either in the case of purchasers or in case of lenders or investors, so that they understand what the steady state is. So those adjustments or highlighting those things are clearly important. And convert, as we talked about before, you can talk around all these things, but really what it comes down to is you have to engage the management team so that they can demonstrate that they know what the problem is, how they're going to fix it, and that they're engaged. And it's not that they're just ignoring it and saying it's going to get better. Because if you do that, it's a losing cause.
Have you had any pushback on any adjustments that you've tried to put through or put onto a SIM where a private equity firm has said, yeah, we're not buying that? You either, you're saying, well, we're adjusting for revenues that were pushed back or pushed forward, so we won't see them coming to fruition until, for the next several months, but they should have been, there's an adjustment because they should have been put into last year's EBITDA or revenue. Have you had any situations like that?
Yeah, so Carrie, that's always going to happen. I see Ken smiling. The way the whole business works is just like anything else. Whether it's financials, whether it's adjustments and the like, whether it's asking price for a business and then ultimately the ultimate selling price and the like, you're always going to present the largest picture, and there is always going to be a clawback and a kick the tires, question adjustments come up, and nobody's going the other direction. Nobody's going to say, oh, I think you missed this and we're going to pay you more. So you got to present it, at 100% and expect that, roughly 75% of it may take, and in some cases less.
And then Ken, from the private equity side, maybe give us under the cover view a little bit. Post-close, is supply chain something you really tackle right away, or is it something you typically engage an outside resource like Wendy to work on, or is this something you double down on with the management team and really try to improve?
So I would say right now in the post-COVID world we live in, it is really about working the issues that we see through due diligence, through their past performance with management team, and say, here's the risk we see. Here's the immediate risk that you've demonstrated that you're struggling with, or here is the risk that we truly do get concerned about in the next 6 to 12 months. And what we're trying to optimize now for, at least in our portfolio, is to make sure that security of supply is optimized. And we may decide that we'll put off optimization for cost just to ensure that we can produce product, we can serve the need. Because I will tell you, I've got one company that we bought during COVID that the father and son owners, the founders, sat around their kitchen table and said, you know what, this is going to be a great opportunity for us, but we're going to have to put inventory in place because we think our large competitors are going to get nervous and hold back on cash. And so they doubled down on inventory. Is the company running probably 2 to 3 turns lower than they should? Absolutely. But they've taken so much market share. It was a great investment. And so our plan with that company is we're going to let them continue to do what they're doing. And then once the world kind of resettle in the new normal for supply chain, and specifically this with steel, then we'll worry about optimizing that supply chain for cost with the appropriate security strategy with it. So it really depends, but I would tell you it is an immediate conversation, both pre-close with the management team of what they really would suggest we do as new owners, and then immediately after close, we say, all right, what is our strategy? We've got to continue to work on it. Like I said, we optimize for security of supply right now versus cost.
Carrie, let me just add to what Ken said also, just one thing about that. in the planning and the like. Many times when you're going through a sell side process, all your the clients and the companies you're selling are inclined to say, well, that they think that leaving working capital on the table is going to be a bad thing. And it's always a big push to reduce it, because you're going to get a multiple on the business, and then you're including the working capital and what it is. But I'll have to say is in the current status, as we said, with COVID and with supply chain issues, skimping there is the wrong direction. So I just wanted to, since Ken was going into that, I wanted to add to that.
Wendy, we hear a lot about reshoring, bringing production back to the US, especially production that is over in China. To what extent do you think this will help to improve our supply chain? And is this something that, again, if a company can take advantage of it, something to think about to highlight in a SIM or a sales process that could really then help you boost your valuation? You're on mute, Wendy.
I think that's a great question, and it's one that you answer differently depending on the year. I mean, literally, it's cyclical. You see people bring things back into the United States, and then they go back, overseas 3 or 4 years later. So, what I would love to see out of this is that people are starting to bring things back, to the United States where it's available. And that's really the key. Sometimes there's just not an option, to have a deep bench of suppliers for whatever the materials or products are that you need within the United States or North America, which forces you to look at a global strategy, from a sourcing perspective. But we are seeing, more and more people be motivated by mitigating risk of the supply chain by bringing things back to the States. A lot of times the reason people would go overseas is to reduce costs, because China cost of product was lower, labor is lower, or Thailand or Brazil, wherever they chose to source and even manufacture overseas. But similar to the inventory strategy that Stephen and Ken just talked about, people are willing to pay a little bit more to bring it back to the States so that they don't have that over the water delays. They're able to literally, drive or fly, to meet the suppliers face to face, within a day, and just the convenience of it, and then the mitigation of the risks, all the risks involved in having a shorter, more compressed supply chain. At this point is worth it, because it takes the volatility out of the business and lets them focus then on what they need to be focused in on, as opposed to supply chain being their constant worry.
Ken, something you pay for? They said,
Yes.
Yeah, we brought it back to the US.
30 years of trying to optimize to the total lowest landed cost is not going to work in this environment we live in. So you've got to decide, what is it worth to you for security of supply? And don't be afraid to pay for it.
Yeah.
And maybe Ken and Steve, I'm going to pitch you two against each other with some COVID adjustments that you've seen recently. In particular, when it comes to supply chain. Steve, has there been anything that you've sort of put in the SIM or you've discussed with the management team that you thought, you know what, this is really a great way to look at it, and let's start with the positive, and a great adjustment that really should be there? And then conversely, is there something that you put in there and you were like, guys, let's just go for it and let's see what sticks? And if the PE guys are going to give us any credit for this thought process.
Yeah. So, while I did indicate that there's can be some adjustments and the like, there are a plethora of other adjustments that are going to certainly hit the EBITDA line above and beyond supply chain. And the reason I'd say that, Carrie, is we talked about earlier in our conversation today that you can't, and I think Wendy's the one that said it, you can't go to the P&L and find a line item that says supply chain. So again, they're probably less so in specific numeric and financial adjustments, and more so in the emphasis in terms of the words and discussion about the business state of play as to where it stands and the like. So in terms of getting overly aggressive or getting beat up. I'm not going to say that there's that again, and this comes to your question from the first question from the start, is that this is kind of a middle of the road item as it relates to the financial and the valuation. If you don't have it and you got real problems, you're going to have real problems. If you're excellent, as Ken said, he'll pay for it. And if you're in the middle of the road, as long as you can demonstrate that you've got your arms around this and you know what's going on, you think you're well suited. But so unfortunately, you're not gonna get the cage match here, because we're not gonna have a huge level of adjustment that Ken's gonna pick at.
Ken, have you seen any adjustments where you just, took the pen and said, no, not happening? That one I'm not going to buy.
For sure. And to Steve's point, I mean, these adjustments are never looked at in isolation. They're always looked at in the total of the business, right? And I'll pick up the cover a little bit and let people peek in. The one adjustment I think that we're always willing to look at, if you can document it and prove it. And one of those is, we had happen to us in our sell process. So I was on Steve's side of the business where we had computer chips, right, preventing engine shipments and preventing us from shipping our power units, right? And we could clearly demonstrate that this was a temporary phenomenon. We hadn't lost the business. We weren't losing market share. And the revenue that we thought we were going to get during our hold period is now going to, go over beyond the exit date, right? And the new owner is going to pick it up. And all we wanted was, we wanted credit for that, right? The things that I will definitely always push back as a buyer is, don't try to do an adjustment because the supply chain raised their price on you. Everyone is dealing with that. That's just something you as a business, it is impacting your EBITDA. It's impacting every EBITDA. I want to know, how are you mitigating that? Are you taking price? Are you trying to get cost out otherwise? But I'm just not going to pay for that, because that's your business. And I expect you to give me the strategic answers that I'm willing to pay for, but just trying to give me a COVID adjustment on that ain't gonna fly.
And then maybe we'll finish up here on, go ahead, Steve.
The price adjustment thing, I agree with Ken as well. So for instance, in one of the capital raises we're doing right now, prices have gone up. What the company is able to demonstrate is that they've gone back to their customers and have pushed those into the future price and have gotten changes. So I mean, one of our customers has one of our sales process, capital raise process right now. One of the customers has a 12% increase in price that they just pushed through. So that's going to go forward from now till either things rectify and prices kind of come down, or it's a permanent change.
Yeah, and I would add to that, we're focusing a lot on the infrastructure of the operations, the supply chain, and its impact in managing that. While you're doing that, it is so important to have a customer experience plan as well. I mean, I don't know about you guys, but communication is the key. I think, most customers are, see what's going on. They understand, there's even maybe a level of expectation now that costs are going to increase, that there could be delays in deliveries, those sorts of things. I just think that constant and continual communication with them, and making sure that that you are resetting their expectations well ahead of the time that something does happen, the better off that you're going to be. So, the client loyalty, abandonment, and those sorts of things, about the only thing you can do right now is just be constantly communicating. The more transparent you are with your customers, the more they're going to trust you. So while you're working on all this back stuff, you got to be pushing that forward out into your market as well.
And Ken, is that standard due diligence now to really dig in and make sure you get those customer calls under your belt before the transaction is completed? And that's, one of the questions on the list, to make sure you really understand, have there been price increases, and have they been able to push them through to the customers?
Absolutely, because like we said, supply chain doesn't show up as a line item on the income statement. You got to poke where it rears its head. The other thing I will tell you is we're doing more due diligence on what we think the competition has done on price, and has the target been able to keep up with that? Are they a price leader? Are they a follower? What are they trying to do to mitigate it? Is there pricing power left in the target is have they overpriced themselves and they at the risk of losing market share. And so it's really complicated how we try to triangulate where the target is and the company is in relationship to their competitors, because that's a big operational thesis point for us. And where are they now post-COVID, and where do we think we can take them if we decide to buy them?
And maybe we'll finish up here with just touching on technology, which, Wendy, maybe I'll start with you first. You know, what are the latest and greatest technology features that we can use to really help us, A, have more visibility, but B, just control the volatility in the supply chain, or at least make sure when it is volatile, we're a little bit more prepared to deal with it?
Yeah, I mean, you know, all of the back office operating functions within the supply chain, inventory management systems, transportation management systems, forecast demand planning software. I mean, those are all there and have always been there. Where I see the market and a lot of our customers starting to really lever up on the digital side is really around data and the ability to sort through complex data through a digital data warehouse and aggregation and harmonization of data, and then be able to actually, you know, craft the story that you can look at every day, right? It's the same storyteller every day. You're able to look at your dashboard and say, here are the 6 operating metrics that, and if I watch the trend on these, I'll be able to at least kind of forecast forward. But I also understand the health and wealth of my supply chain and how it's impacting my business, because I also have these 4 financial indicators right here. And I know this is really hard because, you know, just about every company that I work with, they have so many systems in play. And especially in private equity, if you're acquiring and bolting companies together, you may have 3 or 4 different accounting systems, 2 different operating systems, 4 CRM systems. And, you know, rather than right now take on the risk or the time and investment of actually consolidating all of those to one CRM, one accounting system, one operating system, a lot of times you can put a Band-Aid on that, or at least, you know, pull yourself forward and let that continue to operate, but focus in on pulling the data up and harmonizing it from all those systems so that you're able to get that line of sight visibility on the things that really matter to your business. And I know the C-suite CFOs and CEOs have seen this, you know, tremendously help the business by being able to look at those things without having to spend a lot of time, you know, digging data. They can, you know, kind of dimensionalize it and look at cause and effect really easily. I think that's a huge trend and a huge shift. It's been around for a while. The concept is not new. But it's always been kind of a luxury and a nice to have when you look at investments on the technology side. But I think today it's the game changer. I think it's what, you know, what can actually allow you to operate the business with surgical precision, eke out, you know, several points of profitability as a CEO or a CFO without actually having to be in the business, you know, all the time, kind of micromanaging through all of that.
So Steve, I'm going to throw this to you because Wendy's telling us what is possible, but I'm going to jump to you to say, where are we starting? Because I know working down here in the lower middle market, many times when we go in and start to look at a company, you know, a smaller company, maybe under 10 million of EBITDA, that sophisticated supply chain metrics are really not yet in their wheelhouse. Can you give us a little background on your opinion when you go in and start to talk to these management teams?
Okay, so never want to complain about your clients, but you're exactly correct. So again, my background, I spent 30 years with large global Fortune 100, 500, 1000s. So tons of resources, tons of people that are focused in on all of this, good processes. You know, the companies I was with was principally is W.R. Grace and then Alcoa and then DuPont. So we had great product, you know, and I've done Six Sigma, I've got, you know, yellow belt, green belt, and black belt. I've got lean. I've done other business process improvements. So with that, all that being said, it's a world of the difference. many of the people in the emerging to smaller middle market, they are in fact just scrambling to keep everything together. If they can afford to have a dedicated resource to this, it's phenomenal. Typically, they're going to have to go out and outsource this. If they can have a consultant, just as Wendy or Light come in and explain how to go about doing this, that's ultimately, I think that's the best place for them to start. There shouldn't be any pride of authorship, but you have to, when you, as a management team, you again have to realize what you need, realize what you don't have, and then you got to devote some resources to it. It's not going to be your along the lines of what we talked about with Ken earlier. When the problem occurs, it's a problem and everybody's going to be all hands on deck to solve it, but you can't just do that. You can't have a fire drill every time.
And then Ken, are there some solutions that you would really recommend that you've used successfully to digitize or to pull in technology to a lower middle market firm, really to improve some of their supply chain management?
Yeah, great question. So at LFM Capital, our targets are typically between 3 million and 15 million at EBITDA. So we see the gambit of what these lower middle market companies have. And so our strategy is that I have a resource on staff for me that will go in and even prior to doing the due diligence, I've become a big fan of Power BI, having this kind of the same background as Steve, that working at Caterpillar, I got spoiled with processes, and I got spoiled with an army of people and an army of cash that we could deploy to go do analysis. But I would tell you that with the likes of a Power BI, I can quickly, we did it just with one of our portfolio companies, within 5 hours, we were able to ingest all of their supply chain data purchases, and we were able to put up a dashboard that was fairly comprehensive within Power BI that connected directly to an Epicor. It doesn't need to be through an ERP system. Most of our companies, if they don't have ERP, they have good spreadsheet management, right? A single source of truth. And Power BI is very flexible. It doesn't care. And the nice thing is you can automate it, and you can get some real top-notch dashboards that can drive both the monitoring, but more importantly, decision-making. So that's what I've tried to steer our companies towards. I don't want to spend a lot of money. What I want to do is surface that data that's typically hidden on some of these desktops someplace. And the founder may be making these decisions by gut, but we're trying to take them to the next level. And it's a process of teaching, right? And so that's what we do.
All right, I think we are out of time. So Ken, Wendy, Steve, thank you all very much for your insight.
Thanks, guys. It was great to see everyone.
Yeah, my pleasure. Thanks for monitoring, Carrie.
Thank you so much, Carrie, for facilitating the discussion, and Ken and Stephen and Wendy, thank you for participating. A lot to digest there. If you do want to review today's webinar, it will be on our YouTube channel by tomorrow. If you are participating in the Deal Connect meetings, you'll want to log out of this link and log into the separate link that my colleague circulated last night. If you need it, just reach out to me. But again, I want to thank all of our speakers today, our sponsors, and our audience for joining us. We have a lot coming up. We'll be in touch. But until then, stay healthy, take care, and we hope to see you all soon. Thanks again, everyone.
Thank you.
Thank you, everyone.